Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is September 18th, Wednesday. We are going to take a look at one out of the healthcare sector, Abbott Laboratories. Now, before we get too far in the video, if you could do me a huge favor, hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, that's what we focus on this channel. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell so you're notified whenever we put out any new content, and drop a comment down below. Let me know what you think of Abbott Laboratories. Is it one in your portfolio? Is it one you're watching? Is it one maybe you're selling? Maybe you're concerned about their future. Let me know in the comment section down below. Let me know what you think of the video. Love to hear from you. And a special thank you to all the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. Over 1,000 subscribers now. So those of you out there who may be lurking in the shadows and haven't joined us yet, make sure you hit that subscribe button. Again, join us on this journey to financial freedom. Join the Vested Interest community. Help us get to 5,000 subscribers. We are growing, but the only way we continue to grow is because of people like you. So again, really appreciate everyone out there. Now this is the Vested Interest Stock Screener. This is how we are going to run through the video. We'll see how it stacks up at the end, see if it meets 5 of 8. We will not look at price to book on this one. We use that for financial companies like banks or insurance companies. Now you can use price to book for any company. Just if it's outside of a bank or a financial company, don't use the one as fair value. Make sure you are comparing the price to book of the company you are looking at. In this case, if we're talking about Abbott Laboratories, you compare it to something in the same sector and same industry. So Abbott Laboratories might be compared to something like a Johnson & Johnson, a Pfizer, Bristol Myers Squibb, Medtronics would be a good one as well. Companies that are similar, that produce similar products, you'd want to compare their price to book to the one that you're looking at, and that would give you an idea of the range that you should be in, comparable range for similar companies. Now, back to Abbott Laboratories. Check them out at www.abbott.com. That's www.abbott.com. That is their homepage where I pull this information from. Creating life-changing technology, from removing the regular pain of finger sticks as people manage their diabetes to connecting patients to doctors with real-time information monitoring their hearts, from easing chronic pain and movement disorders to testing half of the world's blood donations to ensure a healthy supply. Our purpose is to make the world a better place by bringing life-changing health technologies to the people who need them. That's our commitment to helping you live your best life. And that's really their bread and butter, right? They're a healthcare company. Cardiovascular care, diabetes care, diagnostics, neuromodulation care, nutrition, branded generic medicines, right? So there's your Bristol Myers Squibb, your Pfizers. That's why they're producing medicines too. They're over 135 years old. They are in 160 plus countries, and they have 114,000 people working around the globe. Again, www.abbott.com is their homepage. Go ahead and check them out there if you want to know more about them. Now, the reason we are taking a look at them, down 2.75% on the day, we are talking about Abbott Laboratories, ticker ABT, out of the healthcare sector, closed out the day at $114.88. 52-week range as low as $89.67, as high as $121.64. They are not quite within 15% of their 52-week low. They need to be right around $103 per share or lower. They're not quite at their 52-week high either, kind of floating in the mid-range, leaning a little bit more towards their 52-week high than their 52-week low. Market cap of $199.897 billion. So this is a large cap company. A beta of 0.72, so they are less volatile than the overall market. Beta is the volatility of the market. 1 being the market. Anything under 1, less volatile. Anything over 1, more volatile. Price to earnings, PE ratio, 36.24, $36.24 price to earnings ratio is high, in my opinion. Much higher than other companies in the healthcare sector right now. EPS, earnings per share, $3.17 per share. Earnings date sometime between October 16th and October 21st. So if you are interested in earnings call, make sure you tune back in for that. Forward dividend, $2.20. They are a quarterly payer. We'll see that here in a little bit towards the end of the video, what they pay per share per quarter. Their dividend yield is a little low at 1.86%. But again, if you were to wait for them to drop a little bit lower, and as they pull back, this yield will go up. Ex-dividend, maybe you can get it over 2%, right? Ex-dividend date, July 15th. Looks like they paid out on August 15th, so you would be in line for the next dividend if you were to buy them now, though you're going to have to wait for a couple months to get it. 1-year target estimate of $111.45. So they see some downside as far as price per share from where it currently sits. They don't see it going back up to this 114.88 or even hitting the 52-week range. So again, might be worth waiting on this one if you are interested. We're going to jump over to the right here, look at dividend yield theory. To do that, we look at their 5-year dividend yield average of 1.63%. We compare it to its current 1.86%, or over here where it says forward annual dividend, same number, 1.86%. And since their current dividend yield is higher than their 5-year average, that actually speaks to some potential undervaluation, at least according to dividend yield theory. Now, payout ratio, 66.88. I like under 75%, so it does meet that metric, but I will say it is starting to get up there, right? 75% or lower, I'm comfortable with, but anything over that, you want to be careful. So watch this. If you are in this company, you want to make sure that they maintain this under 75% or 60 or 65, whatever the number is that you put it at. But for me, if it starts getting up into the 70, 75, above that, then I start to worry. Because then that potentially could be a candidate for a dividend cut. We're going to jump down to free cash flow. I like growing free cash flow. It's typically, if a company has growing free cash flow, they will raise their dividends along the way as well. In 2021, it looks like $8.6 billion in free cash flow. 2022 down to 7.8. 2023 further dropped down to $5 billion. Trailing 12 months so far at 5.6. Looks like they've got a turnaround here, starting to go back up. But we did see a bit of decreasing. I wouldn't call 2021 to 2022 a decrease, because if you look at the repurchase of capital shares here, they repurchased $2.2 billion in 2021, increased that in 2022. So I think most of this drop in free cash flow can be accounted for by the decrease or the increase in repurchase of capital shares, right? They went from 2.2 billion to 3.7 billion. So I believe that accounts for that, though you'd have to do the math. It's going to be pretty close. But there is a big drop from 2022 to 2023 numbers. But again, it looks like they may be back on the upswing in 2024 here. We'll have to wait till the rest of 2024 shakes out, because part of the trailing 12 months, that's what TTM stands for here, is 2023 numbers, right? We're only in September, towards the end of September, so we have about 2.5, almost 3 months of data still from 2023 in this trailing 12 months number. Now, jumping over to stockanalysis.com, the previous page was Yahoo Finance, where I pulled this information from. I am not affiliated with either site, just two places I like to go for information, and I do recommend more than one source. Don't blindly copy or blindly look at just one source for information. Their information could be inaccurate, it could be outdated, could just be plain wrong. Sometimes, we all make mistakes. We're human, and these sites are all built and managed by humans, so it's just the nature of the beast. 9 analysts have taken a look at this over on stockanalysis.com. They do call it a strong buy. Now, if you were to go to the stock analysis webpage, you'd be able to click on each one of these tabs here on this little half circle, see how many might call it a strong sell, a hold, a buy, or a strong buy. So they are leaning towards strong buy, though it's right on the edge of a buy and a strong buy. Low estimate of $107, which would be a 6.87% decrease from where it currently sits. Average estimate of $124.33. That would be a 8.22% increase from where it currently sits. And if it happened to hit their high of $143 estimate here, that would be a 24.47%. All the while, you could collect that 1.8% dividend yield. Now, jumping into statistics, looking at how efficiently this company reinvests its capital back into itself, we like to look at here on vested interest, return on equity and return on invested capital. I like 10% or better for both of these metrics. Return on equity sitting at 14.44%. That beats the 10% I'm looking for there. Return on invested capital, not quite there at 8.41%. I think I might just split these up and give them their own line. I have them tied together right now because it is really both around financial efficiency of a building, and maybe I'll keep it. I don't know. I've been kicking around going back and forth between splitting these one up. Let me know what you think down in the comment section below. Should I split these up and they be their own standalone metrics here, return on equity being its own and return on invested capital, or should I leave them combined? Let me know in the comment section what you think. So this one would not get a check because they are combined. 8.4% is not egregiously below 10%, but it is below 10%, so by the metric, it doesn't meet it. EPS growth, I like 5% or better projected over the next 5 years. This is smoking high, 3 times what I look for at 15.26%. Very nice. And revenue growth forecasted at 6.5%. Very nice there as well. Now, jumping over to the dividend history here, as you can see, 52 years of growth, quarterly payout ratio, they're saying 69%. I think Yahoo Finance had them at 67. Either way, they are starting to creep up there, but under the 75% that I look for. Dividend growth, nice dividend growth, high single digits at 8% here. Buyback yield of 0.33%, so that means they are efficiently buying back their shares. They're doing it whenever they're below value or at least fairly valued. That's what that's telling you. Shareholder yield positive at 2.24%. You want to see positive shareholder yield. They do pay out on the February, May, August, November timeframe. And going back to January 2022, they were paying 47 cents. Raised it up in January 2023 to 51 cents. Most recent raise was January 2024 up to 55 cents. And I would anticipate if they're going to continue this 52 years of growth, you'll see another raise in January as well. Now jumping back over to the vested interest stock screener, understand the business. That's where we always start. So check there. Unless it's so difficult, you don't understand how they're making the revenue. You don't understand what they're selling, what they're doing as a business. I start with their homepage. So I look at what they're selling, some of the products that they offer. So we get a check there. Growing free cash flow, no check there. We had the one down here. Growing dividend, we got a check there. Nice high single digit growth, 8%. Payout ratio is under 75%, though it is starting to creep up there in the high 60s. Check valuation based on dividend yield theory. Dividend yield theory says this one is potentially undervalued, though it doesn't give you much of a margin of safety. Buy below current cost basis or within 15% of a 52-week low. It does not meet either one of those. It's not in my portfolio, so it can't be below my cost basis, and it is not within 15% of a 52-week low. Return on invested capital was not over 10%. Return on equity was no check there because I still have them tied together. Again, let me know what you think in the comment section down below. Should I split these up and make it 6 of 8, right? Or 7 of 9, or 7 of 10, or I'm sorry, it would be 6 of 9, 7 of 10 if I split these up. Earnings per share growth was over 5% at 15%. Very nice there. So check there. So it is 1, 2, 3, 4. It does meet 5 of 8. So it would make it on my watch list. It actually is on my watch list. Though to be completely honest, I am not looking to add anything in the healthcare sector right now. It is my heaviest sector. And I have been adding a little bit to Pfizer now and then, as well as to CVS. So I continue to build out this sector. And I have a rule that I don't want any one sector to be over 20% of the portfolio, possibly 25. If there's a big run up, I might let it go to 25. But if it gets much more over that, then I back off buying, and I might even trim a couple positions depending on how much they've run up. So healthcare is one of those positions, but Abbott does look interesting right now. Again, let me know what you think in the comment section down below. But that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And drop a comment down below. Let me know what you think. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So if you have a company you'd love me to take a look at their stock, like Abbott Laboratories, again, go ahead and drop it down below, and I'll try to work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money and should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.